I'm Michael Simpson. I'm chair of ULI Columbus. ULI collaborates across disciplines and sectors to foster collaboration, share knowledge, and imagine a better built environment. We welcome you all today for this important discussion on the 2021 Community Reinvestment Area Residential Abatement Policy Update Recommendation. With that, I'd like to turn it over to Aaron Prosser, Assistant Director of Housing Strategies for the City of Columbus.
Alrighty, good afternoon, everyone. Thank you for joining us this afternoon. As Mike mentioned, we're going to present the proposed updates to the residential tax incentive that the Development Department has been working on for the last little bit, and just able to, I have a few other folks here that will be able to answer questions. I'm going to walk through the presentation pretty quickly, and then we'll be able to have some conversation, questions, and feedback. So just to get started, again, I'm Aaron Prosser. I'm the Assistant Director for Housing Strategies. I am new to the City of Columbus. I've worked with a lot of you in other capacities, but I've been with the city now since June of this year. So the residential tax incentive program is one that this is pretty straightforward for a lot of you in the room. The cost of construction, land costs, all the other things that go into the development process, in a lot of times don't end up equaling out to the income that you can get off of the property. And so there is a gap that is there and has been there in Columbus for a number of years. And in order to address that gap, there's the opportunity to forego the tax that is on the improvements in the development. So the tax remains the original tax value. The abated tax is the value of the improvement, and that is for a period of 15 years, years 0 to 15. After year 15, the entirety of the development is on the tax roll. This is one of the most important slides I want to talk about in terms of how we've evolved the residential tax abatement. As I said, originally it was really there to address a gap in the construction costs relative to the income that the project would produce. As we looked in 2018, the City of Columbus started to see values changing in a lot of our neighborhoods. We saw increases, and there was an opportunity to think about a certain segment of our population, and we used typically area median incomes to talk about different levels of where folks can afford to live in our community. And we looked across the spectrum, predominantly in 2018, looking at 100% and 80% AMI. And what I think is important about this, and this is all included in the fact sheet that you guys picked up as well, but really wanted to look at who those AMIs included. And when you look at folks who are single earners in their family, even at the 100%, you'd be looking at folks who are teachers and firefighters. If you have a dual income family, you may be looking, and with a couple kids, four-person family, you may be looking at a police officer. If you go down to the 60% AMI, if you're a single earner, you'd be looking at folks that are veterinary technicians and security guards in our community. As we go down to a family of 4 with a dual income, you'd be looking at potentially a pharmacy aide and a cashier that would be sharing a household. And so these are folks that in a lot of our opportunity neighborhoods where we're seeing rents rise no longer have the opportunity to participate in the market in those communities. And so in 2018, the city took a look at the residential tax incentive study. I'm sure a lot of you were involved at the time. I know ULI hosted a similar meeting at that point, really looking at what the value of that abatement was and if there was the opportunity to capture affordability in that abatement, in especially the high opportunity neighborhoods where we were seeing rents rise. And so in 2018, a couple big questions were asked, how effective have the incentives been in supporting neighborhood revitalization? And then how important, how does that support inclusive growth across neighborhoods? Again, making sure that all of our folks can choose different neighborhoods throughout our community. And based on the studies that were done at the time, there was the proposal to tier the community reinvestment areas. And so there ended up being 3 designations. The first being market ready, the second being ready for revitalization, and the third is ready for opportunity. And these were based on a set of distress criterias and really understanding where those neighborhoods were in the growth of the market. Market ready being the place where we were seeing the highest rents and the least distress. And then when we worked our way down to ready for opportunity, where we're seeing lower rents and increased number of distress criteria. And so when we looked at the landscape in 2018, around the residential financial support, we really looked at a couple big things to call your attention to. When we talk about area median incomes and where we've landed with the abatement policy, really between that 60 to 100 is really where the conversation has been. That's in a lot of ways due to the fact that when you look at supporting residential between the 0 to 30% area median income levels, you not only need to subsidize the construction, but you're going to need to subsidize the operating as well, because those rents are going to be low enough to require additional operating subsidy. We also have really great tools that live in between that 30% to 80%, including low-income housing tax credits and some of the opportunities we've had around 4 and 9% development projects. The residential tax abatement also does a great deal to support those projects and are often utilized by our affordable housing partners, so they become part of that stack, not only just addressing folks in the 80 to 100 in the current iteration of the policy, but also really looking at supporting projects from 0 to 100 right now. And then in the Ready for Opportunity neighborhood, we have the residential tax abatement that's obviously across the entirety. So in that 2018 iteration, there was a requirement added for both market ready and for market ready, and for ready for revitalization, that you include units at 80% and include units at 100%. Each of those designations was required at 10% of the unit count. And part of that legislation at the time also indicated that this policy needed to be reviewed every 3 years. So that was 2018. We're now here in 2021. That's what brings us here today. So we took a look this year, really wanting to understand how the residential markets have changed. I think we're all very aware at the pace with which Columbus is growing. A lot of us saw the recent 2020 census results. It was certainly not surprising, and we're all kind of feeling that in the neighborhoods that there is a change occurring. So we wanted to take a really 2021 look at that change in our community. And for that, we worked with both Strategic Insights, and we do have Nathan here from their team who will be diving a little bit deeper into the gap analysis that they did to take a look at our neighborhoods in 2021. And then we also wanted to look at how the 2018 policy performed and how well it had delivered those inclusive units. And this is the general. I'm going to let Nathan dive into the real deep part of how this works, but we asked Vote to take a look at cash on cash return. So really using that as a proxy for how well the development was going to fare in that initial slide that I showed you relative to construction costs and income. And then we also had them look at a proxy for financing feasibility, right? How well would the project, how attractive would the project be to those folks that are financing developments throughout our community? And we had them specifically look at Short North, Near East Side, Hilltop, and the Linden neighborhoods. Based on that work, we took a look at our 2018 policy and we took a look at where we had some increased value in some of our strong neighborhoods. And I'm going to walk through the proposals. This is also all included in the sheet that you received when you came in the room. For those of you who are online or virtually, you can find it on the Development Department website. It is the CRA fact sheet. So for those of you who may not be able to see the screens as well, really the big differences is in the affordability criteria. Again, in 2018, we were asking for 10% of the units at 80% area median income, 10% at 100% area median income. And then we were looking for 2021, based on the increased value that we think the abatement has, we are going to be offering 2 different options, really responding to the desire for that affordability to either be captured deeper or wider to allow us to include those units as a requirement for the abatement. So the 2021 proposed policy for that 15-year tax abatement would be to set aside either 10% of the units at 60% and 10% at 80%, so a little bit drop into the deeper affordability, capturing that 60%, or the option for the developer to provide 30% of the total units at the 80% AMI. So that would be the wider opportunity to capture that affordability. Another thing the abatement does do is not just multifamily, but has applied in a lot of our neighborhoods relative to single-family construction. So for the market-ready areas, you can receive the abatement, but if you do on a single-family new construction or rehabilitation, it will need to be an affordable home offered to those below 120% of the area median income. And that is true again for new construction and single family. In 2018, there was an inclusion of a 5-story height requirement. As I mentioned earlier, one of the questions we asked was how the 2018 policy performed, and that 5-story requirement did create some issues in some of our communities where we didn't have plan recommendations that called for 5 stories, and so we had a little bit of conflict there. So we have removed that 5-story height requirement from the market-ready areas. We have also removed the buyout option, so there will no longer be the opportunity to pay a fee in lieu of providing those affordable units. And then we also looked at unit distribution and really looking at units, the affordable units being commensurate with the mix of units that the development has. So if it's 50% one bedroom and 50% two bedroom, those affordable units would need to be distributed accordingly. We roll into the Ready for Revitalization area, and again, you'll see the 2018 policy where we have today is that 10% of units at 80 and 10% at 100% AMI. Looking towards to 2021, again, you have that option. You can either go deeper or wider, capturing the 60% AMI or additional units by requiring 30% of the units at 80%. Again, we've adjusted the single-family new construction and rehabilitation. You will need, if you take the abatement, you will need to have those homes available for folks earning less than 120% of area median income. And we have removed the buyout option and required that commensurate distribution across the affordable units. Our Ready for Opportunity neighborhood remains the same. As we looked at the information that we got from BOAT for the neighborhoods that fall into that third CRA category, we did not see the opportunity to require affordability in those communities, and that will remain an abatement that you can get into those third Ready for Opportunity communities. Another update for 2021, we have a number of legacy CRAs. These are CRAs that were put in place prior to 1994 when there was a change in the Ohio Revised Code relative to CRAs. At this time, it is the downtown, it is Brewery District, and the Jeffrey Place CRAs. There is no requirement for affordability today. There are some pretty big limitations to how much we can make amendments to these legacy CRAs. And so we have a pretty straightforward update for 2021, again, allowing the developer to choose either requirement to provide 10% at 60% and 10% at 80, or again, do that 30% of the unit set aside at 80% AMI. The final thing we looked at for 2021 was really just the CRA designations and those categories I mentioned earlier. They were reliant on a set of distress criteria, and those distress criteria, the data set is the American Community Survey, which is a set of data set that we are able to get on some years. The most recent year we have is 2019. So we did take a look at that update from 2018 to 2019. We did not have any of our CRAs that changed categories based on that distress criteria, and that is, again, the most recent information that we have in those on the distress criteria. So I bring back this slide of the residential financial support, and I think this is an important part of the conversation, just going back to those AMI levels that I showed earlier. This is one tool in the toolbox, and this is part of a broader strategy that we are going to be looking at in the coming years relative to just the whole housing ecosystem and understanding the pressures that Central Ohio is under as we continue to add population and we continue to see housing prices rise, and we have some opportunities to really look across a large spectrum of tools. So this is one tool that allows us to include those folks that are currently starting to get priced out of some of our opportunity neighborhoods, a place to have in those developments as they are developed in exchange for that tax abatement. And as you can see, it starts to already build out. You know, we do have the residential tax abatement, but we also have the affordable housing bond, which the mayor announced a couple weeks ago. We do have those funds committed, and they will result in 1,300 deeply affordable housing units in Columbus. And so really looking at, hopefully in the next couple years, you'll see a much bigger stack of tools and projects that we'll be working on over the course. And that is the high-level presentation that I can provide. I think there are a lot of folks in this room that are interested in some detail from BSI and the gap analysis that they provided to us that gave us what we needed to make the proposal that we did. I'm going to have Nathan come up and talk, and then I think the balance of the time, we really want to hear from folks if you have questions or feedback. So we will go ahead and I'll come back up to the mic. I've got a number of partners here, as I mentioned, from our housing division. Director Mike Stevens is here as well. So hopefully we can get your questions answered as you guys have them today. So I'm going to introduce Nathan from BSI.
Thanks, Aaron. I've been asked to keep my comments brief so that we can have maximum time for questions on specifics of the analysis. Well, my name is Nathan Young, and I'm a partner and an analyst with VSI. And I should say that VSI was involved in the original analysis back in 2018, so much of the analysis that we completed for this update would build upon the analysis that we had completed back in 2018. So our objective with the gap analysis was to forecast the financial feasibility of multifamily development with rent affordability and tax abatement considerations. So there were two primary financial metrics of study. So we considered cash-on-cash return and then also debt service coverage ratio. And we analyzed those two metrics, one because we wanted to define a metric that was really important on the developer side, and then also define a metric that was very important more so on the financing side of a project. So our variable assumptions in detailing these metrics was what was the cost to build a particular unit type? And we evaluated 4 different product types within this analysis. So we looked at townhomes, low-rise, mid-rise podium, and then also steel construction. And we analyzed various pro formas of projects that have actually been developed throughout the city of Columbus, and we're able to derive average construction costs, both hard and soft costs, on a per unit basis. And what we found is that the average pricing was ranging between $180,000 and $258,000 per unit. Now, again, that's depending on the product type that was being developed. Now, not included in that was the land costs. And within the different typologies that we looked at, whether we were looking in the short north, the east side, Hilltop, Linden, and then also we did do some segmentations within a couple of those various CRAs. We found that the land cost was floating somewhere between $7,000 and $40,000 per unit. So that derived an overall all-in cost somewhere between $187,000 and roughly $300,000 per unit. So those were really kind of the top line costs that were informing our analysis. So then the further variables that we considered when deriving the debt service coverage ratio, and then also the cash-on-cash return operating expenses. We figured 18% of revenue, taxes, they were just based on 35% of the land costs, with the land cost being the variable that we utilized on the second point there. And then with the debt service, we assumed a 30-year loan at a 4% interest rate, and then with a 20% equity commitment by the developer. On the revenue side, so we were able to derive the revenue of the project based on what the theoretical rent that project could achieve. And that was based on our analysis of several multifamily developments within the city of Columbus. So VSI, we specialize in feasibility analysis, and particularly we really specialize in site-specific feasibility analysis. So we are looking at dozens of multifamily developments within the city of Columbus every year, and I would say that number probably approaches close to 50 to 100. Now, obviously not all of those are being built, but we are getting a very good detailed evaluation as far as theoretically what are the costs that are going into these particular developments. So we were able to derive a fairly robust and detailed evaluation of what is that actual rent that project could achieve. And then within the revenue assumptions, we were assuming a 95% stabilized occupancy. So then we wanted to kind of determine, okay, what makes a project financially feasible, assuming those two metrics that we're looking at debt service coverage ratio and then also the cash-on-cash return. So what we determined with debt service coverage ratio, if a project fell below a 1.15, that was just kind of a threshold of that project is probably not going to get financed. A bank probably is not going to look at that deal and finance the deal. If it's above 1.25, high probability that the bank would finance the project. And in between 1.15 and 1.25, it's possible, but you are getting into a cautionary realm there. So the project may still be financed, but it's going to be kind of dependent on the strength of the applicant and other various metrics of the project. So with cash-on-cash return, I probably should have had a bit more detailed on this slide here, but if it's under 5%, that's just not going to yield return. It's not going to make sense for a developer to build that particular project. And then we said above 8% likely to yield an acceptable return. And in between 5 and 8%, it's a low return, so it may make sense for the developer, but it is going to determine on their overall investment objective. And really that green category, when we did the overall analysis for the city, we actually segmented that into two different ones. So if I'm looking at this kind of as a stop sign, stop, slow, go, probably the middle between the yellow and the green would be maybe a running yellow light. So really 8 to 12% would be that kind of moderate range, and really anything above 12% of a cash-on-cash return is what we determined would be financially feasible. So those are all my prepared remarks, Aaron. I'll turn it over to you.
Thank you, Nathan. I'll probably rely on you for some of the question portion as well. As I mentioned in the beginning, this is part of our just really community meeting process that we're undergoing on the development department side. Ultimately, this will go before City Council, and there will be a process associated with that as well, following the typical council process. In the meantime, we have the opportunity to answer any questions or take any feedback that you all have based on the information I shared and certainly what Nathan shared as well. We are live stream right now and being recorded, so if you have a question or feedback, there is a microphone on this side of the room, so we'll ask that you do come up to the mic so that you are part of that recording, and it will also amplify throughout the room as well. So I don't know if there's folks that have pressing questions for us at this time. Yes, sir.
Question and a comment, if that's okay. So question for Nathan. Did you guys look at any real-time cost information when putting that together and sort of where you landed with hard and soft cost?
That one is not going to work. So you're going to have to join me up at the podium.
We did look at real time, actually, and our original numbers were probably about, depending on the area and the prototype that was being developed, was probably somewhere between 7 to 12% lower than what were presented in this presentation. So we did look at some current construction costs for that, to consider the rising costs that we have.
Got it. Thank you. Yeah. So, one, just a sort of comment on that from our perspective, we're currently pricing a couple podium projects, and we're seeing hard and soft costs excluding land north of 300 a unit, so it would be pretty significantly off the scale, and I think we're in a kind of a cost environment that's changing by the hour, by the day in some cases. The other comment that I just want to make from our perspective, first and foremost, thank you to ULI and to the city for convening this meeting. We're incredibly supportive of affordable housing. It's critical that we build not just affordable housing, but all types of supply in our market. I think everyone in this room would agree. We continue to be concerned about the unintended consequences of some of these changes, where we have to see a significant rise in market rate rents to sort of offset the impact. And we would encourage the city and folks that are looking at this to consider bringing back a buyout option with tiers, depending on if you have to build structured parking or you don't, depending on what neighborhood or what area you're in, whatever criteria the city thinks are appropriate. But having a buyout option that could then be funneled into fully affordable projects, I think makes all kinds of sense to do. And we'd also encourage the city to think about the dramatic shift, particularly for the downtown CRA, which continues to struggle with COVID impacts, occupancy challenges, concession challenges, to go from no requirement all the way to 10% at 60 and 10% at 80. It's a pretty dramatic change compared to some of the other areas that have been for a while at 10% at 80 and 10% at 100. So would encourage the city to consider that, and appreciate you guys making the time.
Thank you, Frank. Are there other folks that have questions or comments this afternoon? Yes, sir.
Michael Kelly, Kelly Companies. Wondering if any thought has been given to where the cutoff would be between projects that are grandfathered in under the old policy and new ones. There are some that I know of that I'm involved in that are happening in some distressed areas that have taken a long time to put together, and the deal's been consummated based on economics of the existing policy. And they're underway, but not yet building permits. So I wondered if you had any thought on that. And then, second question, just on the distribution of units, if it's 10%, has to be 1 and 2. I think your example was if it's 50-50, then that 10% affordability needs to be spread between 50 and 50. Any thought on if you have a 100-unit project, but you have 2 penthouse units or anything like that, just, how does one of those need to be, obviously, sometimes you have more than just 1 and 2 bedrooms, but thank you.
Nope, thank you. On the question of the transition period, as we look towards moving out of the 2018 policy and into the 21 policy, we don't have an official timeline right now because that's going to be based on when the legislation is approved by City Council. But looking again at the similar process to what happened in 2018, where there were certain thresholds that you would meet in order to maintain your status as being 2018 CRA threshold. And again, looking back at 2018 and understanding where those thresholds were really meaningful and where we may be able to be a little lighter in terms of how many of those that we require, but giving that opportunity for projects that are currently in the pipeline, have been financed according to the 2018 policy to go through the process and end up in that grandfathered status and not part of the 2021 update.
So you'd be looking back at how it was phased in. I mean, is it possible it could be perhaps a zoning filing as a clear demarcation between projects in flight and projects not yet consummated?
In 2018, it was when you had your entitlements that was the first benchmark. And there was a timeline for that at that time was 2 months from the adoption, which was July 31st of 2018. So in a couple months that are very different from a public meeting standpoint than we're in right now, it being in the holiday season. And then there was a year for building permit and then a year to certificate of occupancy, I believe. Yes, I'm getting the nod. And so those were the thresholds in 2018. And again, we're just taking a look at where that makes sense given where we may be in the calendar with this particular update.
Sorry, just when you say a year with building permits, could you just explain what you meant by that?
Well, and again, we're waiting for the actual legislative schedule, so I can't give you a hard date necessarily, but that at the point of legislation in the past, what we had was 2 months to getting entitled. A year from that point, you would have to have your building permit, and then a year after that, you would have your certificate of occupancy. So that was really based on when that legislation was approved in 2018, so we would have a similar calendar that would be created based on when the legislation is approved for this particular update. And then the distribution of units question, apologize. That is something that certainly part of this process is to get that feedback and understand, certainly there is an interest for us that there is some value to making sure that the units are spread across different typologies, but, really understanding what that best tool to get there is part of this process. Mr. Wagenbrenner?
Mark Wagenbrenner with Drive Companies. A few comments. I think when we did this last time, I think the public conversation started in January of the previous year. So the development community really saw the changes coming almost a full 7 months before the legislation was passed. So that does give us, the 2-month period was on top of the 7 months in preparing. And so this one's coming a lot quicker than the last changes. And then the other comment I have is probably the most effective tool we have for affordability is the 4% and 9% tax credit deals. And if we can ask that we really stay vigilant on the rules that guide the 4% deal, that's probably the most fertile resource to fund these deep gaps. And one of the issues is always staying compliant with the 4% rules. And I think it's contradictory in some cases to the spread of units to sell the bonds and to make the tax credits work. You pretty much have to qualify all the buildings in a project, or all the units in the project at 80, 60% or 80% or below. And if we can just keep an eye on that, because I think we all realize that's probably our best asset to meet affordability.
Yes,
Thanks.
we absolutely share that, and it's something that we're keeping a close eye on to make sure that there's not that unintended consequence of taking those 4% deals off the table.
Thank you.
Yes, sir.
Good afternoon. My name is Chris Knopp with New City Homes. Thank you very much for spending the time this afternoon with this group. I wanted to comment that I believe the cost study, the analysis that was done, was mostly geared towards multifamily development, which does get a lot of the attention. But one of the changes that's being proposed, particularly within the middle tier, which is the ready for revitalization neighborhoods, is that single-family homes would not be able to be constructed to qualify for a tax abatement unless there is a level of affordability added to that. So what I guess my fear is that we have thousands of vacant single lots that are in our neighborhoods now not being built on, and only in recent years did it become feasible for those homes to be built. And to remove the tax abatement would probably result in no more houses being built in a lot of those neighborhoods. And when we talk about the ready for revitalization zones, I'm talking about zones 10 in the Hilltop, zones 22, which is on the south and southeast side, including Driving Park. Zone 14 is Milo Grogan, and zone 15 is the Near East, which would include Mount Vernon and Bronzeville. And costs have only gone up for single-family construction, and maybe we can use those lots to build doubles or triples, but there are some zoning barriers as well to that, and that involves cost. So any project under a certain size has a lot of hindrance when it comes to construction costs. And so in order to build that with affordability, there's a pretty large gap in what the cost is versus what it can be sold for. And I think everyone here knows that there's limited funding available to cover that gap. And so if the end result is that the lots just sit there until that funding slowly gets rolled out to build a handful of affordable homes per year, that's not really contributing to the overall shortage of housing at all levels. We have a housing shortage at all price points and also all unit sizes. So it's, we want to encourage the creation of 3-bedroom units and 4-bedroom units, and most of the multifamily buildings are more catered towards studios and 1-bedrooms and maybe some 2-bedrooms, and really aren't conducive to family living anyways. And so if we want to have housing introduced into the marketplace that is good for families in the city, then I think we need to revisit that requirement for single-family homes.
Appreciate it. Yep.
Thank you.
I think that's the opportunity for these meetings, is to make sure we have a right-sized policy, so appreciate that. Yes, sir.
Good afternoon, Jordan Frohm from Valley Recovery Group. Thanks for having us. My question may be outside of the scope of this study, just simply because it was silent on this topic, but I'll go ahead and ask. Let me know if it's relevant. So, obviously affordability is impactful and is important to us as a company as we look at projects around the region. Has any consideration or thought been given to the process in which CRAs are now created going forward, and or adding properties into adjacent CRAs in order to encourage infill? It seems to me that the increase in the area in which CRAs can be applied only adds to the applicability of affordability measurements and encouraging development across the city. If you look at this map, there's a lot of gap space between each CRA, and there may be adjacent properties to each CRA region or CRA district that is ready for development but could utilize those types of products. So.
Yeah, for this particular update, that was not one of the questions we asked. It's certainly been one that's been posed from a lot of different folks and thinking about how we can add more affordability, especially in that 60 to 80% area median income and where we can include those units. So appreciate that. Are there other folks that, yes, Trey?
Trey Giller with Metro Development. One thought I had, and I've shared with you before, is there's a definite distinct difference between a suburban surface park project and a downtown, garage park project, from a cost basis, from a rent basis. The other thing to consider is when you look at the AMI across the region, it's no different from a suburban market to the downtown market. However, the cost structure is so different that you run into an issue when you overlay one policy across two very distinctly different product types. Something to consider as you're looking at the downtown structured parking, higher cost areas versus suburban, just regular street park, or excuse me, just surface parking. Something to consider. The other question I have for vote was, when you did your analysis, it seemed to me that you were looking at the debt service coverage ratio at stabilization, not necessarily when you go into the bank to finance the project from a developer's perspective. Did you guys consider the difference? A stabilized project obviously is a lot different than total entrepreneur risk, or however you want to consider it from the adjustment perspective.
Yeah, we did. We assumed a 3 year at a year 3 stabilization for the projects, and we factor in discounted cash flows when we were looking at the income statements of the projects. So that was our methodology.
When I looked at your underwriting, use 4% as your stabilized rate. Go to Huntington, for instance. There's a stress rate that's somewhere around 6% when they underwrite the projects from start to stabilization. So did you guys consider that? Because there's different rates that you go to the bank as a developer that you have to deal with from a stress rate perspective when you're doing a development.
I can tell you we did not consider that in this analysis.
Yeah. Okay. Thank you.
All right, do I have additional folks that have feedback or questions for us? Again, this is part of the process. We appreciate a great deal everyone coming out to hear where we are in looking at the updates for the 2021 policy, and understanding again that we'll be going through the next phase will be with City Council, and that will follow their process. And so there's opportunity. My email address is up on the screen, my phone number as well. Please feel free to call or email with any questions after you've seen the presentation. There is all the information on our website, the Development Department, City of Columbus. You can find this fact sheet that you were handed today. For those of you who are watching on the live stream, you can go and get that there as well. The PowerPoint is also on that screen, or on that page. And then we do have a recording from last week's community meeting that is up or will be up shortly on that website as well. So if there's additional folks that you think would benefit from this information, please share it widely. And we appreciate, again, just everybody coming out to have this conversation. I'm going to hand it back over to our Chair Simpson. And if you guys, again, if you have questions or comments, please feel free to reach out. And again, appreciate you guys attending today.
Yeah, thanks, everybody. Columbus ULI is really proud to be a part of this process, and look forward to more developments. Thanks, everybody.